Hello and welcome to the November 1st edition of the first MLS Market Intel Report. I'm Leslie Appleton-Young, Chief Economist for FMLS. Last month, we were anxiously awaiting the most recent market stats for signs that rate declines had impacted sales. But before we get to those numbers, I'd like to quickly review what's been going on with rates over the last few months. In early July, Freddie Mac reported a national average mortgage rate of 6.89%. And note that that was almost a full percentage point below the recent high of 7.8% last October. From there, rates continued to decline as market expectations of a significant rate cut in September grew. In effect, investors were beating the Fed to the punch, driving rates lower in anticipation of their action. And while the Fed did not disappoint, further aggressive rate declines were now in question. Rates were already lower. And then the unexpectedly strong September jobs report. And what we had was rates beginning to rise with the prospect of further aggressive cuts now in doubt. And that's how the 50 basis point cut in the Fed funds rate turned into a 50 basis point increase in mortgage rates. So while longer term rates will likely decline well into 2025, for now I'd expect some continued volatility. The numbers we have for the FMLS market area suggest a stabilizing and strengthening of the market. Closings in September were up 5.2% compared to last year, the first increase we've seen in quite some time. But the rolling 4-week average for October also came in 5.2% higher, so clearly we have some momentum there. New listings were up 7.2% in September and a further 5.2% in October, while coming soons increased 15.3% over September of last year and 8.4% of October of 2023. What about prices? The average price in the FMLS market area came in the last 4 weeks at $524,064, fully 10.7% above last year. So what's going on? The gain in new listings means that more sellers than last year were encouraged to initiate a possible sale. At the same time, buyers are feeling less urgency because first, they have more properties to look at. Secondly, they're likely expecting even lower mortgage rates in the future. And finally, they continue to face strength in pricing in most areas. So it's a bit of a stalemate, and we will likely see a constrained market until rates get below 6% and even closer to 5.5%, when the rate lock-in effects will start to soften. It's interesting to note that our local numbers are somewhat better than those released last week by the National Association of Realtors. They reported a 3.5% year-over-year decline in sales. And it remains true that over the longer term, the fundamentals needed to support future growth in sales are all present right now. We have increased inventory, we have lower mortgage rates, and we have good job growth. Georgia and the southern region overall continues to lead the nation in growth, attracting new residents because of its robust job market, quality of life, and a housing market that still offers affordable options. Please take a look at the home of Market Intel on the First MLS website to access the most current key market statistics. For FMLS Market Intel, this has been Leslie Appleton-Young, and I'll see you next time.